So it's been a couple of days since my last video, and that's because I've been really busy. The last 2 weeks I was really tied up teaching the Wealth Academy Investor Live Masterclass, which we just completed yesterday. So I just had a bit of time to now do this video on an update on the markets. And by the way, this Wealth Academy Investor Masterclass is our 126th batch that I conducted since we started back in 2005. So you will notice that in the last couple of days, the market has been going down. In fact, it's the first down week we've had in the markets for quite a number of weeks. So before bulls get too nervous and before bears get too happy, let me put everything to perspective for you. So ever since the S&P 500 broke above that very strong level of resistance, we have had a very strong wave up pattern. So year to date, the S&P is up about 12.5%, and of course, it's close way above 20% from the bear market lows last year. So we are officially again in a bull market for the 100th time. You know, when I read the comments, I see really strange comments from people, like some people asking, what makes you think it's a bull market? Duh, because the definition of a bull market is when prices close 20% above the low. So it's not me saying it's a bull market, that's the official definition of a bull market. It's like people asking me, what makes you think that's an insect? Because it's got 6 legs, right? That's the definition of an insect, right? So don't be a dumbass and say, what makes you think it's a bull market? Because that's the definition of a bull market, all right? So anyway, so the last couple of days, market's been going down. It's had the first down week for quite a while. And again, some people have been asking me, why is the market going down? What happened? Well, nothing happened. Remember, the market doesn't have to go up for any reason. The market doesn't have to go down for any reason. The market simply just goes up and down, right? And, you know, the market needs to go down once in a while. It can't go up all the time. In a bull market on an uptrend, prices don't go up every day, every week, every month. They move again in wave patterns. You've heard me say this many times. You wave up, wave down, wave up, wave down, right? So after a strong wave up, we gotta have a wave down. It's like, you know, you can't breathe out forever. You gotta breathe in before you can breathe out further, right? And it's great. You don't want the markets to just go up in a straight line, right? That's not very healthy. You want it to breathe out, breathe in, so that when it breathes in, we've got a chance to add to our positions. And for those of you who know options, we can sell puts to collect good premium during these nice pullbacks. So again, the question would be, how low can this pullback go, right? And again, no one can predict for certain. You know, no one can predict where's the absolute bottom of a wave down pattern, but we could make some intelligent guesses. Okay, how do we make some intelligent guesses? Well, by looking at support levels, okay? So the first thing is, if you take a look at the S&P 500, now first of all, you got to recognize that this is what we call an uptrend, okay? As long as the 20 EMA, which is this red line, above the 40 EMA, that's what we call a short-term uptrend, all right? So we are still on a short-term uptrend with a bit of a pullback over there. As long as the 50 moving average, the thick blue line, is above the 150, we're in a medium-term uptrend, and as long as the price is above the 200-day moving average and the 200 sloping up, we are on a long-term uptrend. So based on the current price action, we are on a short-term uptrend, on a medium-term uptrend, and on a long-term uptrend. So all the trends are aligned. So it's extremely bullish, all right? Even with a pullback, yeah? So if you take a look at recent price action, again, you can see wave up, wave down, wave up, wave down, wave up, wave down. Recent pullbacks have found support at the 40 EMA, or this thin blue line, right? So you could think that, hey, that could potentially be a level of support. So you could, you know, add a marker there. There we are, right? So we could very well retrace down here to this 40 EMA, find support, and bounce back up. Again, no one knows for sure. It's just a guess, right? And that's why for investing, what I do is I add in tranches. For trading, what happens is when price retraces to a potential support level, I gotta see a clear reversal pattern, like a bullish candlestick pattern that's confirmed by certain indicators, certain price action that you learn in our stock trading course, right? So again, these are potential levels. Doesn't mean that it has to reach there, right? But it could potentially reach there. So that's definitely one level to watch. Now again, you never know. It could even be a very shallow pullback just to the 20 EMA, right around there. So that could also be a level, right? So that could be a very shallow pullback over there to the 20 EMA, the red line. It could be a more of a larger pullback to the 40 EMA, or an even bigger pullback to the 50 moving average, which is this line, which coincides with previous resistance, right? So remember, when price breaks out of resistance and pulls back, that resistance will then potentially become support. So we can see 3 levels of support over there. So again, how do you make use of this information? Once again, if you are an investor and you're investing for the long run into, say, the SPY ETF, then you do what we call dollar cost averaging. And the question is, when do you dollar cost average in? Now you can do it regularly, like every month, every 3 months, or you can use support levels, right? So if it hits the first level, you could add a small tranche, right? Hits the second level, add another tranche. Third level, add another tranche. That's how you average in your positions for an investment, right? But if you're doing swing trading, then you gotta wait for, again, a clear reversal pattern at these levels. You look for candlestick pattern, you look for indicators to confirm certain price action, like you look for shakeout pattern, things like that you learn again in the price action manipulation course that we run and the stock trading course. I won't go too much into that in this video, but giving you an overview of where the market can pull back to, all right? Now again, this is looking at it from the daily perspective, daily candle perspective. Now if we go on to the weekly candles, let's switch this to weekly candles. There we are. And on the weekly candles, you can see again a very clear price action. So this was our bear market last year: wave up, wave down, wave up, wave down, wave up, wave down, right? Making lower highs and making lower lows. That's a clear downtrend pattern in a bear market, right? And this is a clear uptrend pattern over there, because you've got higher highs and you've got higher lows. So please don't ask dumbass questions like, what makes you think it's an uptrend? Because the definition of an uptrend is higher highs, higher lows, okay? So remember that when we say it's a bull market, it's an uptrend, it's not a prediction, it's not an opinion, it's a fact, okay? But the question is, how long does an uptrend last? How long does a bull market last? That's something that no one can predict, all right? But generally, when a bull market starts, it usually lasts for at least about 5 years, right? At least 5 years. So I do expect that this new bull market to last at least 5 years. But again, during these 5 years, you're going to have a lot of corrections along the way, which are, again, opportunities to add in positions or sell puts, right? To collect some really great premium. Now, if you take a look at the weekly charts, is it possible that we get an even bigger correction down? Well, again, everything is possible, right? If, for example, the war in Ukraine gets out of hand, right? I know the coup was very short-lived, but you never know, there could be a second coup, like an Adam Khoo. No, that's a tasteless show. But okay, now you could use Fibonacci, right? You could say, okay, hey, this could be an A to B impulsive wave, right? So you got A, B. So if we have a correction, where would the C level be? Based on Fibonacci, you can use Fibonacci's levels as well, right? So if you go to a Fibonacci tool over there, you could say, okay, that's my A, that's my B, boom, okay. So where are possible levels based on Fibonacci, right? So based on the 38.2% retracement, which is considered a shallow retracement, that it coincides with this level over there, right? Which is the 50 moving average on daily candles, as well as the previous swing high resistance, okay? But you never know, it could even pull all the way back to a 61.8% Fibonacci level. That would be a much deeper pullback, which I doubt we'll get there. But again, you never know. In the markets, anything can happen because you can't predict tomorrow's news, right? So let's draw a level over there as well, all right? So bear in mind that even if the market, goes all the way down to here, right, doesn't mean that, hey, we're in a bear market again. No, it's still in a bull market, right? Because it's still a very healthy A, B, C correction, and it will then go up from there, right? So if you ask me what's my guess, now again, my guess is not any better than anyone else's guess. It's just a guess. But my guess is we'll probably find support probably within this zone, right? So that's my best guess. We'll probably retrace somewhere around there, and then and this will take some time. It's not overnight. This may take a couple of weeks, a couple of months, and then in the last quarter of the year, we should have a very strong rally, and I won't be surprised if we make new highs in the market. All right. Now again, we may or may not exceed the all-time high in the markets, but I'm pretty confident that we'll end up a lot higher than where we are right now. Some people have been asking me, the market's really up like over 12% so far for the first half of the year. Could it go higher? I mean, it's really up like 12%. Well, history says yes. History says we've got a good chance of ending high in the second half. So we take a look at all these previous years where by the end of June, the market was up at least 10%. Now, again, June's not over yet, all right? So this is still in progress. But I think there's a good chance that by the end of June, we will still be up over 10%. Right now, we're up over 12.5%. So the market can still go down 2%, and we're still up over 10% for the first half of the year. That was based on Carson Research, credit to them. So what they found is that all those years where, again, by the mid of the year, the market was up at least 10%, you can see that in the next 6 months, which was by the end of the year, the market was higher 81.8% of the time. So again, there's no 100%, but high chance, 81% chance, we're going to have an even higher second half, or the market is going to go up in the second half, right? And the average return of the second half of the year, 7.7%, and median would be 10%. So that would bring the full year return of the S&P up about close to 20%, which is my best guess, right? Now, here's another interesting piece of statistic. The market has now made a new 52-week high ever since its bear market low, which was a 52-week low. Now, recall that 52 weeks is 1 year, right? 1 year. So you can see that over here, this was the bottom of the bear market last year. That was a 52-week low. And now we have made a 52-week high because this is over a 1 year period. This is the highest point in 1 year. Now, historically, every time we get a new 52-week high after a 52-week low, 1 year later, the market has always been higher. It's been undefeated. So take a look at this. There were 13 instances where a 52-week high was followed by a 52-week low. And 6 months later, you can see that 12 out of 13 of those years, the market was higher, which is about 92% probability. And the market was higher, an average of 8.5%. But 12 months later, after the 52-week high was made, you can see that 13 out of 13 of those instances, the market ended higher. So it's 100% probability that the market will end up higher 12 months from a new 52-week high, which we just got a month ago. And the average return is 16.1%. So that's another very bullish statistic for you. Now, for the first 6 months of this year and for the first 8 months of this bull market, you can see that not all the sectors have been participating as much in this rally, right? So in fact, you can see that the rally, the bull market, is being led by 3 sectors: technology, consumer discretionary, and communications, which is obvious because these were the 3 worst performing sectors during the bear market. So usually the worst performing sectors in a bear market become the best performing sectors in a bull market. It's always a mean reversion phenomenon, if you will, right? So technology has led the bull market so far by 35%, whereas the other sectors like energy, utilities, materials, healthcare, and financials, they have been lagging behind. Although some of them are a bit higher over the year so far, right? So over here you can see the S&P 500 in yellow, right, up about 12.5%. But most of the gains were driven by technology, whereas the rest of the sectors, if you take an equal weight portfolio where technology doesn't play a bigger weight to the index, it's actually only up a lot less. Now, is that good news or bad news? Well, there are two ways to look at it. Some people say, oh, that's bad news. That means that the bull market, there's no broad-based participation. It's not, a true bull market. It's only led by a few sectors, right? So that's one way to look at it. I look at it the second way, which is most bull markets always start with only a few sectors with very low breadth, and then the rest of the sectors will then play catch up. So the good news is that if you find that you have not been in the markets yet and you're missing out, the market's gone up so much, I'm too late to the party. The good news is that other sectors are yet to catch up. So if I were that person, I would want to buy more shares of the other sectors that are going to play catch up next, okay? Which I've been doing, in fact, right? As you guys know, my portfolio is heavily weighted into technology, consumer discretionary, and communication. So my portfolio is up very nicely this year, but in the last month or so, I've been adding shares not to my technology companies, not to my consumer discretionary companies, because they're up a lot, right? But I've been adding shares to my other stocks and to new stocks in the sectors that have not caught up yet, because in the second wave of the bull market, those other sectors will begin to play catch up, right? So what are these other sectors that are going to catch up? Well, over here you can see year-to-date performance, again, technology, communications, and cyclicals, also known as discretionary, have been leading the bull market, right? So these guys are going to catch up in the second half. Well, no guarantees, but likely to catch up, right? Okay. So industrials. Now, I recently bought some industrial companies like Winnebago as well as Pool Corporation, right? These are the live buy alerts that I send to my UIP subscribers in my Discord channel. Do subscribe if you want to get live alerts of exactly what I'm buying and selling every single day. I also added a lot of healthcare companies. Healthcare, I've mentioned this before, is one of my favorite sectors. I love healthcare because healthcare companies are very defensive, which means during a bear market, during a recession, they don't drop that much. In fact, they may even go up during a recession because you always need healthcare, right? It's defensive. At the same time, healthcare sector also has relatively good growth because of the aging population, because of people growing older. Healthcare is a secular growth sector. So great news is healthcare stocks are still cheap. Some industrial stocks are still cheap. So there's still a lot of opportunity there if you know where to look. All right, so I've been adding a lot of healthcare stocks in the last couple of weeks as well. Financials are cheap as well, and up to you. Some people like to buy banks. Banks are cheap, but personally, I don't touch that many banks, except for high dividend banks in Singapore. But there are other financial companies that are very cheap as well that I'm looking at. What else is there? Well, yeah, the rest I don't touch, right? So you guys know I don't touch basic materials. I never like that sector. I don't touch real estate, except for REITs. I don't touch utilities, and I definitely don't touch energy, okay? So it's up to you. I'm not saying you don't touch it. It depends on your core competence. Invest in sectors that you're familiar with, that you're comfortable with, right? So those are the sectors that I tend to focus on. So do the economic fundamentals support the bull market? Well, I believe that they do. Now, remember that last year, the main reason for the bear market was because of the Fed raising rates too fast because of high inflation. Now, historically, I've shown you before that every time inflation peaked and went down, the market always bottomed. And I believe that inflation has peaked and inflation has begun to go down for a couple of quarters and is beginning to continue to moderate, right? Now, of course, then there are some people who say, but this year, the problem is not high inflation. The problem now is that the economy may go into recession because of the very high interest rates. Now, again, anything could happen. No one can predict recessions for certainty. Even the top economists can't predict exactly when a recession will come. All we can do is we can just look at the data, right? So far, the economy still remains pretty strong. In fact, on the 20th of June, the housing starts that were released showing the number of new housing construction projects that are started actually was much higher than expected. So this actually increased the forecast for quarter 2 GDP to 1.9%. So first quarter GDP was positive. Second quarter GDP is not out yet, but based on the Atlanta Fed real GDP growth estimates, it is now estimated second quarter GDP 1.9%. Now recall that last year, many economists were saying that 2022 recession is inevitable, but there was no recession. Then they said, okay, 2023 first quarter recession, no recession. Then they said quarter 2, no recession. Now they're saying last quarter, right? So they keep pushing it back. Now, of course, eventually there'll always be a recession, right? But no one knows exactly when. But as of now, the economy is still growing as of now. Now, let's talk a bit more about housing starts. So this was released on the 20th of June. There's a bit of typo over here, 20th of June. Housing starts jumped 21.6%. That was way higher than expected. It jumped to 1.63 million units last month, the largest gain since 2016 October. Okay, so over here you can see total housing starts, big jump in the month of May, right? So again, these are the number of new housing projects being started. Now, within that total housing starts, you've got single family homes and multi-family homes. Now, multi-family homes starts surged 28% in May, and it's now up 40% from a year ago. And this puts the current level of multi-family starts at the highest level since December 1985. So what does this all mean? All right. And now, even though housing starts have been going up that much, all right, completions have also been increasing. That means the number of new homes being completed. It used to be very slow, a backlog because of the supply chain problems of the pandemic, but now they are being completed a lot faster. Now, the number of completions in housing projects increased 23%. So that's pretty good. But even then, housing starts in black over here, or blue, dark blue, have been outpacing home completions. So what does all this mean? It means two things. Number one, the fact that housing starts are increasing at such a high rate means that builders, home builders, are positive about future demand for condos and rentals. Now, you often see a surge in housing starts after a recession or after a bear market when the economy starts to recover. You very rarely see this before a recession, right? So something to think about. Again, the other point to note is that supply chain issues have been easing, which is leading to more completions, more houses being completed. Now, as more houses are being completed, that means that there'll be increased supply of houses, which would mean more supply that would help to reduce the rents in the rental market, and that would reduce the inflation pressure, right? So this has got two good implications. Number one, it tells us the economy is still growing. Number two, it is at the same time helping to moderate inflation. Now, if you take a look at some real-time data like the Zillow index, you can see the Zillow index that measures rent on a yearly percentage change has really fallen sharply recently. So have the apartment list index in green, right? The one in red is a lagging index, like 6 or 8 months lag. So that's beginning to turn down, okay? So when you see the CPI data that's high, that's because the rents have not come down, because the rents are based on this red CPI primary residence rental index, which is 6 to 9 months lag, right? But the real-time rents have been really coming down. So this should start to come down in the next couple of months to bring down the CPI. So again, if you take a look at CPI inflation, the consumer price index, it is now at 4%. Well, remember the target for the Fed is about 2%. It's gone down to 4% from 9% a couple of months back. However, core inflation is still about 6%. So people are saying, well, it's still a bit sticky, right? But the reason it has been sticky at 6%, the main culprit has been the rent component of the CPI. Again, take a look at this chart over here. You can see that the one in brown, energy prices have been falling, right? Oil has been falling, natural gas falling, food has been falling, food prices have been going down, okay? You have got core goods that have been more or less going down as well. You have got core services, ex-shelter, services index going down. The only thing still going up is shelter, which is rent. And the reason it's going up is because it's a 6 to 9 month lag. Okay, if you take a look at the real-time rent index, it's been going down in the last couple of months. Okay, and rent accounts for 34% of total CPI and 43% of core CPI. So once the rent index comes down, which is the lag one, CPI should fall pretty significantly, right? So those are the two boogeymen of the market. High inflation, which looks like it has peaked, coming down, and of course the concern about an economic contraction, which I don't believe we're going to see a recession. Now again, this is the official definition of recession. You recall that a few months back I made a video that said that we are already in a recession, right? We're in what we call a rolling recession, which means that different sectors go into recession at different times, but we don't have a nationwide official recession, and that's still my stand. Now, a bit of tongue-in-cheek over here. The Economist, which is a very popular magazine, their latest issue, what was on the cover? The trouble with sticky inflation. Now, for those of you who have been following The Economist for many, many years, you know that many investors and traders treat this as a contrarian indicator. In other words, whatever is on the cover, the opposite tends to happen. Again, don't take my word for it. Go online, do your research, and you find that every time The Economist says something, the opposite happens, right? I'll just give you one example, but again, go online and do your own research and you see many more examples. One of the classic examples was back in 2016, where the Brazil index, this is the Brazil ETF, EWZ, was collapsing, right? It really went down. And right here at the bottom, okay, on January 2016, The Economist had a cover that said Brazil's fall, the disastrous year ahead. What happened the moment the magazine came out? That was the start of the bull market in Brazil. Okay, so the fact that The Economist is saying that, oh, inflation is sticky, could be a great contrarian indicator. Now again, none of this is 100%, but it just goes to show you, right, that anything can happen in markets. So we pay attention to the current trend, we pay attention to the current data, and we don't make decisions based on predictions. Hope you enjoyed this video, and I'll see you guys in the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.